Ooh. Good afternoon, everyone. Yet again for another Wednesday afternoon. Amy, hope all is well today.
Thanks, Jim. All is great.
Excellent. Well, today we have the fantastic luck of having one of the head people over at Annexus, Kevin Daw, is going to talk a little bit about the Annexus fixed indexed annuities and how they're different than most all other index annuities out there. Only a small portion of advisors have access to the Annexus products. DMI is one of the marketing organizations that do, so you all have access to the Annexus products. So I've known Kevin for a couple of years now. He knows his stuff, and with that said, Kevin, I'll just hand it over to you.
Jim, appreciate it. Also, Amy, glad you're on the phone with us here. Yeah, we wanted to just spend a little time today really talking about who Annexus is and some of the differences it is. Not a whole heck of a lot of time on the product. That's something we can definitely handle, if we want to, afterwards. But a lot of times, it's important to understand who Annexus is first. And I always start out the conversation about who we aren't. And what we are not is an insurance company. And it's very important to understand that. What we do over here at Annexus is we design and we create product, and we partner up with insurance companies to be able to facilitate that product, out to the agents and more importantly, the end users, your clients, that are out there, to offer some pretty innovative solutions. We'll talk about a couple of those solutions that make us a little bit different. But when we talk about Annexus, it's really about talking about product innovation. A safe accumulation, putting more money back in the client's pocket is everything that we're looking for in creating anything that we do. You can see some of the first that we were able to do under that fixed indexed annuity chassis. As you get familiar with the Annexus line of products, you'll notice that all our products are uncapped products. We really want to position that client to be able to get as much upside potential by not risking a penny of their money as they possibly can. So we don't have any caps that are on there. We'll talk a little bit about that guarantee plus accumulation, but it's also important to understand one of the distinct differences between an Annexus product and any other traditional FIA out there is that we have the ability to track the values on a daily basis. And this is very important. First and foremost, it's very intuitive to your client. I want you to think about all the clients that you probably sat in front of. More importantly, where we were looking to be able to reposition those assets. Most of the clients have spent their financial life up to this point being able to see and track the values on a daily basis. So it's counterintuitive to put them into something where they might have to wait a year, or nowadays, some cases 2, 3, 4, and even 5 years out to find out what's going to be in their account. But it's not just that intuitiveness, it's for a couple of different triggering points. So the example I like to use is, let's just say we had a policy started out on February 1st, and we get a year or two into the policy in November 17th, and your client comes to you and says, hey, I'd like to be able to take a free withdrawal, or unfortunately something happens to your client, like they pass away. Well, what's going to happen in the event of a death, our first triggering point, on any other traditional indexed annuity out there, they're going to go back to whatever that policy value was on February 1st. And that's what's going to get passed on to the beneficiaries. There's no way for them to know what happened on November 17th, more importantly, where they were as far as in their allocation, cycle. But because we can track the values on the daily basis, the beneficiaries in this case are going to receive full value up to the day of death. But it also, again, works again for that free partial withdrawal, RMD, confinement, and terminal illness. Now remember, just because of the Secure Act was passed a little bit over a year ago, we still have to take out that RMD. We moved the date to age 72, but it's still a requirement. We actually see almost about 2/3 of the business that we receive on fixed indexed annuities is qualified money. So that tells us on 2/3 of the money that's on the books with our carriers, an RMD is going to have to come out. So let's go ahead and take a look at that RMD. By being able to track the values on a daily basis, we can actually give the client the ability to take that RMD when they want it or how they want it. because what's not going to happen is they're not going to forfeit any index gains towards that withdrawal. So let's say on February 1st, we had $100,000. Your client goes to take that free withdrawal or that RMD, comes to you and says, you know, hey, Jim, I'd like to be able to access my free withdrawal amount. Well, for easy math, let's just say that's 10%. And in most cases, it is with our products that we have. I know 10% of $100,000 is $10,000. Client's going to receive their $10,000, go off and do whatever they want to do or whatever they needed that for. But what's going to happen in this particular case, the insurance company that we work with, whether it's Athene or Nationwide or AIG, they're going to say, is there any gain in the account on November 17th? And do we need to make sure we credit it towards that withdrawal? Well, let's just say they're up 10% for easy math again. 10% of $10,000, which was the withdrawal, is $1,000. That $1,000 is placed back into the accumulation value, and now the client on an Annexus product is moving forward with $91,000, opposed to any other fixed index annuity out there. They're moving forward with just the 90. So the ability to track the values on a daily basis, one, is very intuitive to the client, but it's also very beneficial in the event that we may be taking some type of withdrawals. Also works if the unfortunate event, if your client gets confined or diagnosed with a terminal illness, they receive full value up to the day of that confinement and not forfeiting any index gains. It's these innovations that we have, the tracking the values on a daily basis, that's allowed us to really, create some pretty good partnerships, out there for strategic partnerships. You can see some of the bigger names like Nationwide or, New York Stock Exchange, Blackstone. These are, partnerships that we've been able to forge through our history, which is almost 15 years now. We've been around doing this, and we've created quite a reputation that has allowed us to have and form these partnerships that we have. Nationwide is one I wanted to just talk a little bit about that really kind of is a little bit of a different way about creating some type of a guaranteed income for a client. So it kind of falls in line with, why or what we're talking about today is what kind of sets Annexus, apart from everybody else. Just launched a new product, an updated product of our New Heights called the New Heights Select. Allows us to do a couple of different things. Going back to that tracking the values on a daily basis, what it allows us to do on the Nationwide Select product is we have the ability to bucket the strategies that are in that product itself. So we can create, maybe 2 or 3 or 4 strategies that we want to take a look at. But what it also allows us to do is have an enhanced lock-in. So that bucketing that we're taking a look at, if I use just 3 of the strategies that are available on here, you say we can go a third, and pretty much a third that's there to be able to create that 100% diversification, the correlation that we want, whether we're looking at a domestic or a global type of play. But Nationwide, we have the ability, once during its allocation period, to lock that value in. So what we can take a look at is that if that index itself achieves to the point where we have met or exceeded the expectation or what we were looking for this period of time, we can actually pull the trigger on that and lock that in premature before the end of the allocation period. Why we call it dynamic is that if I do split this into 3 different indexes, I can lock them in independently. So it doesn't mean I have to lock the entire account value in or shut all 3 of them down. I can lock them in individually as I want to go. So if I do have, 3 different indexes that we're taking a look at, we can actually lock one in and let the other 2 continue to ride based upon how we've diversified, that money that's in there, where one might be able to be more advantageous because of the global positions that it has, and we'll let the domestic side, like our Zebra index, ride a little bit more. So it's that independent lock-in that is a really unique feature of that Nationwide product that goes in line with tracking the values on a daily basis. What we also did with Nationwide is we created a pretty interesting guaranteed income rider. I know that income is a big part of a lot of people, especially moving forward, that's out there, especially in guaranteed income. One of the things that we found out with guaranteed income is that it can be quite expensive. And what I mean by that is quite expensive to the client in the future. So what we did is we created the guaranteed income rider, and another unique thing that's to an Annexus product is we have what we call guarantee plus accumulation. What I challenge everybody out there, that's listening today is to start to look at those guaranteed income products and see what that accumulation value is, maybe 10, 15, 20 years down the line, especially after you start to take that accumulation. What I mean by that guaranteed incomes can be expensive, if I take some of our partners that are up there, but more importantly, some of the top, guaranteed income products that are there, some of you may be using them or familiar with them, you can see that if we take a strategy on one of those products and we're looking at pure accumulation, you can see what that par rate, that cap is, whatever that modifier is. But as soon as we add the guaranteed income rider on these companies' products, they change that modifier. This is what we're talking about with that guaranteed income can be expensive. It comes at the cost of future accumulation. So what we set out to do with Nationwide is to be one of the top guaranteed income products that are out there, but still provide future accumulation. So we created a rider that has a 10% bonus. It's 7% compounded for 10 years. So that's our worst case scenario that we're looking at. But we also have that accumulation value that can exceed that guarantee. And if that accumulation value has exceeded that guarantee at the time they go to take income, we're actually going to go ahead and use the higher of those two amounts. The reason that we have the ability to achieve higher than that 7% compounded is, one, remember, we're an uncapped strategy, but with our strategies, we do not change our par rates when we add that guaranteed income. So if I was looking at the Nationwide product for just pure accumulation, currently right now on the Nationwide, if I looked at my strategy A, I have 125% participation rate in our SG macro, for example, with a 1.5% spread. I add the guaranteed income rider on there, it still says 125. I was looking for a no spread product. Currently right now we're at 90% on the participation rate, but you can see when I add that guaranteed income rider, we still stay at that 90%. So we're not, sacrificing future accumulation for those guarantees. So we've taken a look and we kind of just compared, just to kind of give you an example of what that might look for a client in some comparisons with some of the top products that are in this space. One of them is that Protective Life Guaranteed Income. You can see right now, and these are based upon most current illustrations, for both of the products that we had. We had a 60-year-old, and we just held on to it for 10 years and started taking income at age 70. I'm going to call it a draw. We're both at 10.5. And I start taking income, and at age 80, we have a cumulative income, both at 105. But remember, one of the unique things about the Nationwide, product that we have is that we have the ability to do better than what that guarantee was. And if I go back historically and use that SG macro, we actually had periods of time in this 10 years that where we actually increased or stepped up that income. And if I compare that, I actually have a cumulative income of 132 opposed to their 105. But this is what we're talking about. At age 80, you can see what that cumulative income is. But the accumulation value on the New Heights product is still $295,000 and some change, where on the Protective, there's zero. They actually provided the guaranteed income, and we're not saying that they didn't, but it came at the cost of future accumulation. We now have the ability on that New Heights product to have some value that might be left to a surviving spouse as a death benefit, or funds available for any additional expenses that may come up at a later date. You can see what the cumulative income is, for that particular, scenario that we're taking a look at. Now, there are some products out there that do provide that guarantee plus accumulation story, or a lot of times I'll get asked a question when I'm doing a one-on-one here. Well, that's just a nice scenario. You waited 10 years and then, to take income. What if we needed income a little bit sooner? Well, Symetra out there has a product, and we actually had a 5-year income deferral. And you can see we're still starting income a little higher than what the Symmetric product is. And over this 15-year period up to age 80, you can see what our cumulative income is from a guarantee standpoint. However, we were able to step up a little bit because we do have that increasing ability because of our strategies being uncapped. You can see historically what that would have been. But Symetra, even though they have a guarantee plus accumulation story, we're at 233 in this case, and they're at 138. So you have to look at your income, and we all provide that guaranteed income, and we're all pretty close. Right now, Nationwide happens to be the top in a lot of different scenarios. But more importantly, do you have the ability to have that future accumulation that you might be taking a look at? Because you can see here, even in this scenario, we still provide, a little bit more, from the cumulative income because we don't sacrifice that future accumulation for the guarantee. So one example that might set, Nationwide and Annexus off, a little bit different. One of the other ones is a very long-standing sales solution that we have with one of our partners, Athene. We have a product called BCA with Athene. Athene, we all go all the way back to American and National Viva days, has been one of our longest-standing relationships. And we've had a solution on there called the Family Endowment Rider, and it's used for legacy. And you can see the Family Endowment Rider right now is a 3% compounded up till age 85. What allows us to really use this for a legacy is that on the Family Endowment Rider itself, 3%, the first 3% that comes out of the product is a dollar for dollar reduction. So it's not a pro rata reduction, and it allows us to maintain those accounts at a later date. Depending upon the strategy that you use, we can go all the way up to a 10% premium bonus with that Family Endowment Rider. We have an alternative solution. Also, if you're looking for maybe just a little bit more, and you think that people like Professor Schiller or Professor Siegel, which have strategies on the BCA, can do better than maybe that 1%, we drop that guarantee down to 2%. But we stack 100% of the interest earnings at the end of each allocation period on top of that. So if we can get some growth on there, maybe 2, 3, 4%, it's 2% plus 100% of those interest earnings. It allows us to bump up to a 5% dollar for dollar reduction that's on there, and we can go all the way up to a 14% premium bonus that we're there. But the sales solution that we've used on this product, it has been in place, now going on almost 15 years. That's there is what we call our RMD, sales solution. And what the RMD is, remember, I say about 2/3 of the business that we see that's coming in is qualified money. So we know that RMD is going to have to take place. But you may have a customer just like John and Patty here that's very similar. John and Patty, John is 65, Patty is 62. John's done a great job of accumulating over, his work life and has $1 million sitting in his IRA. He's concerned that as he starts to come up and take out his RMD, that he's going to live, long enough that he'll consume a lot of that, and there's going to be nothing left for Patty. Interesting thing on here that hasn't changed for me, I've had the ability to deal with Annexus since inception, is a lot of times when we start to talk about RMD, the number one response that I've always heard back is the client doesn't want it, doesn't need it, is being forced to take it. This is a great way that they can show them that we can actually take that RMD but leave a substantial amount of their original premium to the surviving spouse, and in this case, Patty. And what we're talking about is just using the Family Endowment Rider. I'm just going to use the 3%, compounded that's on here. And I want everybody that's on here today to look up in that upper left-hand corner. I'm going to assume the entire time that John and Patty were in here, we made 0%. So this is worst case scenario all the way across the board. John lives to the ripe old age of 85 and he passes away. He's taken, basically $524,000 in his RMDs. But because he had the Family Endowment Rider on there, he's still leaving Patty over $986,000. So put in $1 million, never made a penny the entire time we're in there for the 20 years, and still leaving close to $986,000 to Patty that's there. This is a great sales solution that's available on our BCA product with one of our partners, Athene, that's exclusive to, the BCA product. It's there. It sets it apart, from a lot of the death benefit or legacy plays, that are available, that are out there. So just a couple of things that, Jim, that set us apart a little bit. Just wanted to touch base on it. Obviously, we could spend a lot of time digging down deeper into each one of these products that are there, but the ability and the different innovation that Annexus is being able to provide is something that we just kind of wanted to talk about today. I would encourage anybody who would like any more information on this to reach out to Jim, get a hold of him. Jim, if we need to do any one-on-ones and dig deeper, into any of these products or these strategies or anything like that, I am more than happy to do that, but wanted to be respectful of everybody's time today and just kind of give you a couple of different ideas of why we think Nexus is a little bit different along the way. And you can see the total benefit of ownership there was, of the million was 1.5. So I will turn it back over to you and just kind of let it bring everybody home.
Excellent. Kevin, appreciate it. Appreciate all the information. I can tell you flat out, when an advisor has a client who's looking for income, I start with the New Heights Select. It's just got a great story about it. And when a person is looking for legacy, I usually start with the BCA and work from there. So, really good products. And I can't stress enough how important the daily tracking is. So if you have a client, let's say you go into the typical fixed index annuity, let's say it's a 1-year point to point. Client calls you 6 months into it and asks you, so how am I doing? You can't answer because you don't know. You won't know how they're doing until that contract anniversary. With all the Annexus products, all the Annexus FIAs, you actually have that daily tracking. So you know how that client is doing each and every day. Might be something small, but for some of your clients, it could be absolutely humongous. So with that said, Kevin, appreciate the time. As we normally do, we like to leave a couple minutes for any questions that people have. So if you do have any questions, feel free to type it in, and we'll go from there. All right, we're just waiting. Kevin, it looks like you may have done such an unbelievable job.
Or put him to sleep, either or. It usually goes either way. So yeah.
No problem at all there. So one question I had in regards to the New Heights, the nationwide product. I know that it's currently not available in California. Is that correct?
Correct.
Now, but I also heard some scuttlebutt that may be changing. Now, you may not be able to say anything, but I just wanted to throw that out there because we do have I work with a lot of advisors, Amy and I do, that are in California. So if they are looking for income, right at this second, the nationwide New Heights is not a fit, but we do have other solutions.
Yeah, California is one of we have applied, this was a brand new product, so we had to submit to each one of the states for individual approval. We are hoped to be in California very soon. Do not have a date. If they do, they don't tell me because they know I get on webinars like this and I share it. But we're hoped to have that very soon and be back in California. We've been out of there for about 1.5 years just because of, the way the state is, and we have to price the product a little bit different. But states are coming online, every day. We added Massachusetts on Monday. So, that is a new state that was added on Monday, as well as Hawaii. So if you have everybody in Hawaii or, that we can work with. But I think the big ones that are still hanging out there, California and also Illinois is one that we're working on. But everything has been submitted. It's just a matter of working with that state's, Department of Insurance and answering their questions to get the go ahead. So as soon as we can get that online, we definitely will.
Yep. No, absolutely. And I think like you said, I think it will be sooner than later that advisors in California will have access to that product. Still looks like we have no questions. So, what, that's fine. I have no problem wrapping this up a little early without any questions. Kevin, as usual, just want to thank you for joining us. This has been some great information. And like Kevin said, if you want to learn more about any of the Annexus products, feel free to reach out to me. We can talk about it. We can even get Kevin on the horn, possibly do a quick little Zoom meeting for that. And also to let you know, in a couple weeks, we do have the other side, the Annexus life insurance. The person that Amy was talking about earlier, Al, is going to be coming on and talking about the Annexus life insurance, how those are different than your typical life insurance policy out there.